apologize. It looks a little rough. I've just got these the private equity numbers, so I want to backtrack just a little bit to 2023. If you remember, 2023 was a rebound year from 2022 when the 60-40 mix was down about 15%. So 2023 was an up year for both stocks and bonds. The 60-40 mix produced a 17.5%, approximately a 17.5% return. As you know, private asset classes, the numbers come in a little bit late. We now we have all private asset class numbers, so I thought I'd start off by sharing them with you. You know, importantly, buyouts showed a 10.7% return for 2023. Some people were concerned that they'd be negative in 23. They actually, buyouts did pretty well, 10.7%, not as good as stocks, but they weren't down as much as stocks in 2022. CDLI, which we reported on our prior webcast, was up 12.1%. This represents private debt. The real estate number, the NCREIF number, was minus 7.9% for the year. If you recall, in 2022, people were wondering why real estate was up when everything else was down. It took them a year, but they caught up in 23 with a pretty significant negative return for the year. Within real estate, we'll say that office got crushed, down about 15%. Somewhat concerning is the fourth quarter number was down over 3%, real estate numbers. So kind of expect continued bad numbers here ahead for real estate. Anyway, what I call the 40-40-20 mix of private equity, private debt, and real estate produced a return of 7.5% for 2023. So anyway, just wanted to put a period on the prior calendar year. Now let's move ahead. So here we are at the end, in the middle of April. What do we see on a go forward basis? So I want to talk generally about the macroeconomic picture. And start off with the same theme I did last quarter. We're in a period of tight monetary policy, unlike the prior 10 years where it's very loose monetary policy. But if you look at this chart, it shows in blue Fed funds rate, in red the trailing CPI number. The difference between Fed funds and CPI really representing the real rate of interest. And if we look at, as of the end of March, we've Fed funds of 5.33, trailing inflation of 3.49, basically the real interest rate of 1.84%. The historical average is 1%. So to me, this reflects really over the last year, the first time in many, many years where the Fed continues to be tilt towards restrictive monetary policy. Inflation, as you know, everybody was expecting a path to the long-term normal of 2 to 2.5%. That's doesn't appear to be happening. Have some later statistics on that. Turning to the next slide. So we're dealing with restrictive monetary policy. Fiscal policy continues to be loose. Here we're showing federal surplus and deficits really over the same period of time as the prior slide. The trend line is increased stimulus. This is surplus deficit as a percentage of GDP. So the government continues to accelerate its support of the economy. You know, ultimately the question is, this transforms into increasing debt. How long and how much will treasuries be in demand? So that's the ultimate question, but we're dealing with loose fiscal policy, restrictive monetary policy, so they're working in opposite directions. So far, it's kind of a toss-up. The real economy, if you look at the right-hand side of this graph, this is quarterly GDP. Really, since the current administration, average GDP has grown at 2%, but if you exclude the early quarters, basically the economy's running at a clip. All these forecasts of recession been dead wrong. Should be a lesson to everybody. And the expectation for Q1 is, I believe, 2.4, 2.5% real growth on top of a 3 handle in the prior quarter. So we've got the government is operating with mixed direction, but overall the economy is really operating pretty full throttle. Just review again our methodology. I'm going to flip into what our expected returns are going to be, but basically we use a fundamental model for forecasting asset class returns, which takes the current yield plus cash flow growth, plus any anticipated change in valuation, plus manager alpha, and that gets our expected return. So here's the really challenging slide in my deck. A lot of detail here, but let me see if I can go through it quickly. So what we show here are different asset classes along the rows. We show the Q1 return, our long-term expected return, and basically how we derive the expected return. How we derive it is actually more complicated than what we show here, but we provide a simplified calculation for ease of understanding, if you will. So importantly, stocks and bonds, stocks were both domestic and international were up over the quarter, 10.6, 4.7 respectively. Prices go up, expected returns go down. So our long-term expected return was at 6.95. It dropped to 20 basis points to 6.75. Importantly, rates or interest rates, they continued to go up over the quarter. Look at whether it's the aggregate or treasury or TIPS index. It was down, so prices went down, yields go up. So if you look at the aggregate index, our expected return is 4.85. I'll make this point over and over again in this presentation, but the trend, the interesting trend in the financial markets right now, in my view, is really the decline in the premium between stocks and bonds. So if you look at our forecast, 675 for stocks, 485 for fixed income represented by the aggregate, that's less than a 2% spread. We had gone through since a financial crisis where that spread was 5% or more. Now it's less than 2%. So again, we leaned into stocks for about a decade. The numbers suggest that, hey, maybe we should shift and lean into fixed income. So talk a little bit more about that. If you look at credit had a reasonably good quarter, or at least returned its yield, 2.4% for the leveraged loan index, high yield bonds, 1.5%. Basically, there was some spread compression. Currently, we have a expected return of 5.4 for both of those credit instruments. On the alt side, expected return on REITs is 6.45%. That looks fairly attractive. Excuse me. But I'll just note that the actual dividend yield for the NAREIT, 4.15%. If you looked at it today, is below the yield on treasuries. So basically, you get paid more, at least in terms of yield, for treasuries than you do for REITs, which is, again, not a good indicator for real estate. Moving down on private equity, again, 9.75%, just reinforce our view that the spread between long-term expected returns, spread between private and public equity is about 3%. In terms of private debt, our forecast went up a little bit because inflation expectations went up. Our forecast for Treasury bills went up 10 basis points. We're now forecasting a levered return on private debt of 9.55%. Looking down in the other column, again, our forecast, GMP forecast is 2.5%. That's real growth. Our inflation forecast is 2.3%. I'd like to just focus on my main point in today's presentation, and that is the dwindling spread between the expected return of stocks and bonds. Here I show a picture of 60 years history in expected returns for stocks and expected returns for fixed income represented by the 10-year Treasury. The blue line has been the expected return on equities. I've been doing this since 1978, and I backdated this to 62. But basically, the blue line has been the expected return, very high when PE ratios were very low. They came down and basically have been relatively flat over the last 20 years, something in the 7% range. Fixed income represented by the green line. You all know that expected returns on fixed income represented by the yield to maturity has come down. Secular decline till a couple of years ago. Now they're on the rise. Importantly is the gray background. Basically in the 70s, it was a very high spread, declined significantly during the 70s. In really since the 80s, that spread has been wide, and today though it's been falling, and it hasn't been. It's currently at 2.55%. It hasn't been that low since 2007. Again, the point is, why do I want to take equity risk? I'm willing to take equity risk at a spread of 5, clearly. The long-term average is 3.5. Now we're at a good 1% below that. If we updated this for the last 2 weeks, it would be even smaller. The point here is, if you look at the fundamentals, it's hard to lean into stocks currently. I will say that it's so I make that statement, and the next 2 slides really say, but be careful. Okay, so this is a slide of earnings per share growth of the S&P 500 over the last almost 40 years. This is on a log scale, so growth looks pretty consistent over time. Real earnings per share growth has been 3.5%. Just about everybody uses 2.5 forecasts for real GMP growth over time. I'll just say earnings per share growth has exceeded real GDP growth over this time period, and you can break it into subsegments. You get the same result. It may just be that corporate America is doing a phenomenal job over time, and instead of 6.75, we have to add 1%, make it 7.75. But even with that additional percent, that spread is still at best at the historical average. And then one more word of caution. You've seen this graph before from me. I often call it the most important graph in investing. But it's basically, it says you got to be careful if you want to bet against U.S. stocks, okay, over the long term, because again, if we look at almost a century here, the compound rate of growth in total return on stocks has been just a little over 10%, been pretty consistent over time, witnessed pretty much a straight line. We have entered decades, though, of zero return, the latest being 2020 to 2010, the 1970s, and the Great Depression. So there are times when the stock market takes a long pause, but pretty much it's the best example in the world of capital formation over the long run. In the case of bonds, during at least for half the life of this graph, up until approximately 1980, interest rates were going up. Returns on bonds were below its trend line. Then interest rates started to decline. It reversed. It was above the trend line. Currently, it's back at trend. Who knows what direction it'll go from here? But obviously, there are fears of even higher interest rates ahead, which I think would give people some pause in terms of leaning into bonds, despite the small spread. And again, cash basically tracks inflation over time. Sometimes real rates are high, sometimes they're below inflation. The average is about 0.5% over inflation, and that's what we use in our assumption. So in terms of historical return, here I look at almost the last 20 years. Basically, I choose this starting in 2004 because that's when all the indexes are available, including private debt. But it basically shows most of the public major asset classes plotting along the capital market line with U.S. stocks at 9.5%. It hasn't been a 20-year period that's been kind to international stocks. Both emerging markets and the EFA stocks have been really extremely mediocre. International diversification has been very, very costly. But what has worked as a delta above the capital market line has been private investments, but private equity, real assets represented by infrastructure, private debt, which we've been very long in, and to a lesser extent, real estate. In terms of now our expectations, so here return and risk expectations going forward, basically similar to the historical 20-year numbers. Most of these asset classes plot near the efficient frontier. Okay, some a little bit above, some a little bit below, but probably within the margin of error. And the only difference being the private asset classes. We do believe that the private asset classes will continue to produce a 3% plus or minus roughly 3% delta over equivalent risk public investments. And we do think private debt is the best risk-adjusted returning asset class. In terms of, I like this. I started doing this about 6 months ago. So what does everybody else think? Okay. And so what I do is I collect capital market assumptions, forecasts for a bunch of other allocators that are pretty well known, take an average of them, both return and risk, and that creates this graph. Okay, so I show, for example, private equity, upper right-hand side of 9.4%. Okay, that is an average of 12 of these allocators. Okay, both the expected return and expected risk. So what does this tell me? This tells me that the consensus 10-year forecast is pretty close to what we would expect. The higher the risk, the higher return, and except for the private asset, private debt, and private equity, they plot along an efficient frontier. I was surprised at how close it was. A couple observations. First, the consensus likes private debt and private equity. Like ourselves, they're expecting roughly a 2% delta over public asset classes. Our assumption is 3. It's higher, but directionally, we're in the same boat. What the consensus doesn't like is U.S. stocks, okay, compared to either EFA stocks or emerging markets. Okay, I'm not sure why. I continue to argue that earnings per share growth in the U.S. More than offsets the higher PE ratios that U.S. stocks have. But so be it. Basically, they've been allocators have been cutting U.S. stock allocations. Also, real estate. Everybody seems to be on board that real estate's not particularly attractive now. So that's quite different from a few years ago. But anyway, that's, basically we have differences, but we're in the ballpark with what these others say. And then what I show is our forecast against the consensus. So if you see in the light blue, CW means Cliffwater. And I just wanted to point out some differences here. So basically, we're consistent with the consensus on private debt and private equity, at least the expected return. We seem to be a little bit higher, about 0.5% higher than the consensus in terms of our expected return on private debt and private equity. But we also have a much lower level of risk. Okay, so our risk numbers are consistent with the historical numbers. A lot of these allocators use public market equivalent type calculations rather than actual private asset risk. But nonetheless, we're in the same ballpark here. And if you look at these other asset classes, the other major difference is we're not so optimistic about emerging markets and EFA stocks, and we're a little more optimistic about U.S. stocks. But other than that, we're basically in the ballpark with these other allocators. Finally, my last slide. So what are the key takeaways? Basically that the capital markets are in rough equilibrium, I feel. The only exception might be this tightening spread between the expected return on stocks and bonds that I've spoken about, which basically I think speaks more towards debt than equity, but we'll see. Second, we continue to think private debt is the most attractive alternative. We allocate significant amounts of capital to private equity. We think that has the highest return. If you're a long-term investor, that will definitely produce the highest return. But we continue to like private debt. Third, real estate problems likely to continue. There's just really nothing that suggests a turnaround anytime soon. Maybe it's a time to buy, but the legacy portfolios are going to really weigh down on total returns. Non-U.S. stocks, likely a value trap. I mean, basically, U.S. over the last 20 years, non-U.S. stocks have done terribly, largely because earnings per share growth is non-existent outside the U.S. And it's not enough to make up for the PE differentials. Yields are about the same. Okay, public bonds regaining their value proposition. Okay, so for the longest time, people are underweighted fixed income. Probably you want to be at your benchmark or your normalized level allocation. And then in terms of balanced portfolio, kind of what if we were going to express an opinion, not knowing anyone's or any institution's particular circumstance, what looks to us as a well-balanced portfolio is shown below there: 40% public stock, heavily tilted towards the U.S., 20 fixed income, 20 private debt, 15 private equity, and 5% other, which could be real estate, depending on the circumstance, could be really opportunistic, if you will, investments. With that, let me stop, Phil, and address any questions that have come over.
Sure. One question off the top: what are the current default rates on senior secured private debt, and has it changed over the last year? I took a chance to look this up. It's at 0.5% right now. A year ago, Steve, I don't have the data offhand. I'm guessing it was half of that.
Yes.
Is it fair to say we see default rates continuing to tick up modestly just because yields are so much higher?
Well, I said that 6 months ago, but the numbers came in very good in the fourth quarter. I think losses are going to be muted, definitely for the first half, if not for the entire year. And by muted, I mean well below the 1% historical average.
Sure. Here's another one. You said that you don't know why the top allocators are so negative relative to Cliffwater on U.S. equities. I suspect at least some of them are expecting some profit margin and/or multiple contraction back towards the median. Why does your forecast not include any multiple change?
Well, basically, given the growth rate in earnings per share, the differential in growth rate in earnings per share between the U.S., which is basically operating at 7, and the new non-U.S. at 0, that roughly 7% differential is fully compensates you for a PE spread between U.S. and non-U.S. of arguably minus 15. So basically, I think it's a fair trade-off. One is a growth market. One is a growth market. I mean, the Magnificent Seven represents 30% market cap. One's a growth market, and the other is a deep value market with no earnings growth. So I consider it's a balance.
Quick question on public bonds, and I like this question, Steve. Would you please comment on allocators should think about taking credit versus duration risk? Should they take these together separately when building a portfolio? What do you think?
Well, I think together, and we've said that for the last 10 years, you should take credit risk, particularly non-investment grade credit risk, and particularly private, because we think you get paid handsomely for it. The duration risk you didn't get paid for. Basically, you had negative real rates for the longest time, and now you get paid for it. Real rates today, are probably today maybe treasuries at, what are they, 4.8 or something like that, and maybe they hit 5. If you look at, say, inflation is 3, arguably, that's a 2% spread. That's at or a little bit above the real return for duration historically. So you're getting well compensated for both credit and duration today. You should take both.
What do you think about, and maybe this is just a buyer preference. Let me put it differently. Would you rather, let's just put private markets aside. Would you rather own leveraged loans as one line item and municipal bonds as another, or treasuries? Or would you rather have a manager attempting the kind of core plus, go anywhere, I'll take care of your credit and duration risk in one portfolio?
Well, I think allowing managers to time one way or the other, it just really hasn't worked. These tactical decisions, particularly with respect to duration, just haven't worked. So basically, I like the idea of, setting a duration, whatever it is, and just sticking to it rather than hiring a manager to, go long or go short. Historically, that hasn't been a successful strategy. And I do believe that leverage loans, the spread is, anyway, the spread there is credit spread there is pretty narrow, but unlike on the private side, but you told me to exclude private, so.
Make it simple. You'll get to talk about it here. Because you were foolish enough to leave the presentation on this slide, Steve, why don't you have more than 20% in private debt, given the high risk-adjusted returns? 20% in public fixed incomes, in fixed income seems high, given the substantially lower expected return.
I'm sorry.
Why don't you have more than 20% in private debt, given your return risk-adjusted expectations? 20% in public fixed income seems high.
Yeah, so this is a constraint, basically for a typical investor or institution. Basically, what this says is I don't want more than 40% in privates. I mean, some might, but I'm saying, given I don't want to do more than 40% in privates, okay, what do I want to do with the rest of the portfolio? And all I'm saying is, hey, whereas a year ago, 2 years ago, I would have said, basically 5% in public fixed income and 55% in public stocks. Now I'm willing to give a more normalized weight public fixed income.
Here's another good question. Why isn't infrastructure anywhere on the page? We know real estate, the outlook isn't great, but should we look at that 5% other as infra? Okay.
Yeah, it could be infrastructure. I mean, basically infrastructure I view as, that basically it's a 7%. And I think there are a lot of things out there that can do better than 7%, but you may find a good infrastructure fund that could do better than 7%. So I just leave it open.
This one's above my head, Steve, but I'm going to see if you can handle it. If deficit is consistently north of 2 trillion, in parentheses, it was 1 trillion for the first 6 months of the fiscal year, then where does all the capital flow? Will new inflation hedges emerge beyond long-dated tips, which have been a disaster?
Don't know the answer. Quite honestly.
That's okay.
I mean,
it's better than making
it has to be.
Yeah.
I will say it has to be financed, and what we're seeing now is, particularly with concerns about inflation, the government has to offer higher and higher yields. So, where's that money coming from? Maybe it'll come from allocations to stocks, real estate, other asset classes that now do not look quite as attractive as they did a year ago or 2 years ago.
What variables will keep, or I'll insert have kept, non-U.S. stocks underperforming U.S. stocks going forward?
Well, non-U.S. stocks.
It's a growth story, right?
Yeah.
There's just how bad is the growth outside of the U.S.?
Yeah, non-U.S. stocks, I think, have been one of the biggest value traps in the name of diversification over the last 20 years. Maybe it'll change, but somehow I doubt it.
This question's a good one. Comes up in Bloomberg all the time. And I think you can extend it to private equity too, Steve. Do you expect the long-term illiquidity premium between private credit and leveraged loans to be compressed as more capital is raised in private credit? Why or why not? And I say maybe talk about private equity too, because it's the same theme. We've been hearing for a while there's going to be this disappearing premium, which hasn't happened yet. Go ahead.
Yeah, so people have been saying that for the last 15 years when I first got deeply involved in this. And the answer is simply the private ecosystem has been growing. So private equity has been growing. The growth of private equity has been pretty similar to the growth in private debt, which basically means that the demand for financing has matched the supply of financing. And so spreads have remained pretty much the same. There is a cyclicality to the private ecosystem, like there is to the public ecosystem. But I don't see any. There's no evidence of any systemic diminishing in the illiquidity premium that we can measure.
Here's a good question, which involves our fund, so I'll modify it. How should investors, we look at senior direct lending at these rate levels, Steve. All the funds kind of look the same. We'd say, focus on fees would be one thing, but what is the alpha that can be pursued right now if someone wants to go hire a few direct lenders?
Well, I don't know, probably 0.5%. I mean, as I've always said, yield or interest income is pretty efficiently distributed. Okay, riskier borrowers, you generally have a higher spread, vice versa. So if it's an efficient market for yield, then it really comes down to alpha equals underwriting skill. And the average underwriting skill for senior secured loans is probably 0.5% per year. Okay, so if you hire a real good one, it's alpha of plus 1%, plus 0.5%. If you hire a really bad manager, it's probably a loss rate of 1%, so it's minus 0.5%. Those are your alpha kind of guardrails, if you will.
I think that one way to think about it, pick your leverage you want, focus on fees because that's a certain loss. But one thing Steve always says is at any given time, any one lender is going to have a bad quarter. But obviously, they don't have all the same bad quarter at once. So if you want to smooth out your return stream, diversify, pick good lenders, accept that not everyone is always going to be perfect, but that in the aggregate, you're going to get kind of the target return you're looking for. For return assumptions, what additional fees associated with private investments narrow the delta to passive low-cost stock? Another way I'd look at this, Steve, is when you show, maybe you can flip back to one of the pages where you show return assumptions. Are these gross or net for private markets? And how much alpha are you putting on that 9.8 in private equity?
Okay. Yeah. So good question. So in all cases, we would consider these largely after fee returns. Okay. So let's take the private equity. We add 3% to public equity because that has been the delta, after fee delta, we've basically witnessed for 4 decades. Okay, it's some 10-year periods it's 5, some 10-year periods it's 1 to 2. Generally, it's a bigger delta in down markets. But anyway, it's after fee. Same thing with private debt, both levered and unlevered. This is after fee. We do show how we calculate those returns. If you looked at our last quarter's report, we'll go into it in detail. So everything on this page is really after fee. Quite honestly, the only exception might be U.S. stocks and EFA stocks, where we basically use index. Assume they're ETFs with very, very low fee.
Steve, what do you think about, just talking about U.S. stocks, picking segments of the market, mid or small cap right now? Is there some screaming value or any value measurements you look at, large cap versus small cap, growth value, et cetera?
Everybody's wrong on that. I mean,
except for you.
If you look historically, growth stocks do the same as value stocks, no difference. Large stocks do the same as small stocks, long term. Anybody who tries to time, what segment of the stock market to be in, that's a loser's game. Okay, I don't understand why, quite honestly, why people bifurcate or trifurcate or whatever the stock market, because there's no evidence that it's worth it.
Steve, I'm looking at this page, and this relates to another question I saw. You've got public REITs, long-term expected return 6.5, and then you've got private REITs at 6.4. So you have the same
Yeah. So
I guess what I'm trying to understand. Go ahead. Yeah.
Yeah, I almost put in a graph to highlight that, but I think everybody kind of understands that right now the illiquidity premium on real estate is either 0 or negative. So that's why we, still, unless it's, anyway, you got to be really careful to go into private real estate right now. You really have to, in terms of pricing, you really need to identify, a transaction value that makes sense. Right now, they don't.
Do you see, obviously, the battle drum coming from the mainstream media against kind of private assets, and it's all hocus pocus, et cetera. Is that something that's been there forever, or is it something that has heightened because they see retail moving into these markets and see susceptible readers? Or do these kind of things blow over? What can you tell us, having done this, 20 years?
Well, I don't know if it'll blow over. Most of the criticism comes from professionals that basically operate with publicly traded asset classes. So they're kind of throwing arrows at kind of emerging asset classes that are attracting flows. I think that's going to continue for the foreseeable future. we just try to educate, as you know, we just try to educate people on what the data shows and let investors decide.
Okay, Steve, I think we're pretty much through the questions there. Anything else you want to share with anybody?
No, thank you very much. Appreciate your support and look forward to talking with you next quarter.
Thanks, everybody. We'll follow up on the more specific items.